Welcome to SF Commercial Property Conversations with Bruce Bean, where Bay Area investments meet expert insights. Get ready to unlock the strategies of commercial real estate success.
So today we have Marc Lipsett with us, and Marc is in the San Francisco market. He's on the debt side of the mortgage brokerage world. And Marc, it's great to have you. I didn't ask you previously, did you grow up in San Francisco? You must have.
I did.
Yeah.
My parents moved here in 1962.
Holy moly. Yeah. All right. That was prime time for San Francisco.
The Giants had just gotten him. Oh, wow. Well, I think they got here. When did they get here in 58? But,
yeah.
But
the Giants were pretty new to San Francisco at that time. So were you with them at that time, or you came along a little later, it sounds like?
No, I wanted to be close to my mother, so I came with her.
A good idea. All right. And then, okay, so you grew up, you went to Boys Town School?
I went to town school.
Town school. Yeah. Okay. And then you went to school off someplace else.
Yeah. Eventually I did go to college. I went to Santa Barbara.
Yeah. Nice. That's all good. And then, so how did you progress there into the world of real estate?
Let me think here. That is the craziest story ever.
Oh, okay. We're into crazy stories on this podcast.
Okay. So my dad, let's see. Let me try and think of this. Okay. So I was in New York and I was doing a lot of, it was just after the Soviet Union had fallen apart.
You tear down this wall.
Tear down the wall, Mr. Gorbachev. That's right. So it was and I was doing business in Russia. So I had a lot of Russian friends in New York, and I was doing business in Russia. My dad said that he knew a real estate developer who was trying to do some work in Russia. And that real estate developer was Jim Boyd. And his company still is much, much bigger now. It's Interstate Equities. And they're a real estate syndicator. It's run by his children. And they were one of my biggest clients in the last cycle. But in any case, he said, you should meet this Jim Boyd. So I was in New York. I talked to him on the phone. He got along. He said, I need some help. I need some projects done. I'm looking for finance. I'm looking for investors, etc. So I started working on packages for him to show investors, and I ended up going to Russia with him. And and I actually met him for the first time in person at the St. Petersburg airport. And so we had a lot of adventures in Russia, but and we made some money. We renovated some apartments in Russia, and we made some money. And but at that, it was 1995. And at that point, he was going back and forth, and the California market was heating up. And he said, I have to make a decision, and my decision is to come back to California, devote my energies here. Would you like to join me in California? And I flew out. I met with his team, talked to him, and I joined him in California. And I started working in his Los Altos office. And so I started working on the principal side. And I basically managed the loans for him and started getting loans for him. And at a certain point, one of my bankers basically asked me if I'd like to join her team. And eventually I did. And that's how I became a banker.
Wow. Well, wait a minute. Let's back up a second. Do you speak Russian?
Я говорю немножко по-русски. I speak a little Russian.
Okay. All right.
Well, I can order a beer.
Did your family speak Russian where you picked it up on your own?
No, I learned with у меня есть кассеты. I had cassettes.
Well, we skipped a beat here. How did you get from town school to New York City?
Actually, I spent a couple of years at Columbia.
Oh, yeah.
Never.
Okay. All
I
right.
have a degree from Columbia Grad School of Architecture, Planning, and Preservation, and there were a lot of Russians at Columbia. Oh wow, that's how I met a lot of Russian guys, and I'm still friendly with them. I'm still, I actually was in New York a couple of weeks ago and saw a bunch of guys, and yeah, I'm still in touch with. I'm still in touch with them.
Well, that's fantastic. And how are they feeling about Russia right now? Just out of curiosity.
Well, one of them is he's one of them owns. He's in the syndicate that owns a bunch of. He owns Pabst Blue Ribbon, here, and he owns a bunch of breweries in Russia and in Eastern Europe, and he's not feeling too good.
Well, they're probably still drinking a lot of beer, so maybe.
No, the beer is okay, but honestly, it was always very difficult there. I mean, no, it's just difficult. It's a difficult environment, but he is Russian and he has navigated.
Oh, I have been to St. Petersburg, but that's a story. That's another story for another time. But
Gorgeous city.
beautiful city. Anyway, all right. So we got to San Francisco where you became a banker, and then now you went out on your own and formed Walker Capital.
Walker Realty Capital, yes, with an old colleague of mine, Walker, and who has been a guest on your show before, and she actually used to work for me, and when I decided to get back into the business, she had a broker's license, and I decided to work with her.
Oh, that's fantastic. All right. So tell me what you think. Okay. So the Fed's just bleeped down a quarter point. What's happening in the current world of mortgages and loans?
Well, rates have come down a little bit. And I think a lot of people don't understand that the federal government and the Federal Reserve, they really don't control interest rates. They control a very small part of the interest rate market. But basically, the interest rate market is driven by supply and demand. Supply and demand for debt. And the federal government can lean, they can push, but they can't buy all the treasury bills they need to sell to fund the government. They have to have outside investors. And if outside investors feel that the currency is going to depreciate, or they feel that there's going to be inflation, which will also depreciate their holdings, they're going to demand a higher interest rate, no matter what the federal government says or does. So they have the main tool the federal government has to control interest rates is the Fed funds rate. And that's the rate that a bank can receive when it deposits excess funds overnight at the Federal Reserve. And if a bank can get, they've lowered it to like 4.25. If a bank can get 4.25 with no risk, because treasuries are regarded as risk-free,
Right.
have to charge more to everybody else, right? I mean, they can't charge their customers less than they're charging the federal government, which is risk-free, right? So that is the tool that the federal government can use. But honestly, if the treasury market, if they can't sell the bonds at, if they have to raise rates to it's an auction. So if the rates have to go up because they're going to buy the bonds, that no matter what the federal government does is not going to, there's no magic button that they can push to lower your interest rate or my interest rate.
So that's contrary to the popular belief, so to speak.
That's right. That's exactly right. And I don't even know if our president knows that.
He certainly thinks he understands it, and he keeps pushing to get the rate.
Right. He's pushing for, but there have been times when the Fed has lowered rates and rates have gone up, because what happens is sometimes what could happen is the psychology of the market is, if the Fed is lowering rates, there's a problem. If there's a problem, people want higher rates on their bonds. So that's that. It's a delicate operation.
But isn't there so much capital, so much dry powder out there right now that is pressuring rates to come down?
The rates have declined. They have declined. I think the 10-year is down about a half, and the 10-year is really the benchmark for home loans. Even though people, typically get a 30-year loan, they typically don't keep them for 30 years. So, when banks make, or Fannie Mae makes, a 30-year loan, they hedge it with, against the 10-year loan, because most loans don't last 30 years.
Right. So they're thinking they can, post-pandemic, when rates were so low, even the banks were thinking, okay, even though I'm giving out a 3% loan, that's only going to last a short period of time.
And boy, were they wrong. Because, there's a typical role, but when rates double, the typical runoff ended, and people would do anything. They would do any kind of maneuver to keep those low rates, because they were half. I mean, if it was a quarter point, you're not going to go to great lengths to get the loan. But if it's half of the rate, then that it becomes more of an imperative, and people, they just didn't roll. Those loans just didn't roll.
Right. Well, so then flipping over to the commercial side, the commercial lenders, fortunately or unfortunately, had short-term loans, and a lot of 3-4% loans now are coming due.
That's right.
And the people holding those loans are like, some of them are in trouble.
That's right. So let's talk about the commercial real estate market in the Bay Area.
Okay, good. Yeah.
And there are three things driving the market right now. Most important, AI. AI is driving the San Francisco, it's driving the commercial market in San Francisco. I mean, it's not big enough. The AI demand isn't big enough to fill the empty space in San Francisco, but it's really the only thing that's creating new demand. And the second thing is return to office.
Right.
San Francisco had the second most San Francisco return to office. We were up 10% last month, and only bested by Chicago, which was up about 12%. So return to office is driving. The AI. I'm sorry. Let me back up on AI. AI is also bringing people to the city.
Right. Okay.
We lost about 60,000 people.
Wow.
And so that was a lot of renters. And we had our rents in San Francisco, the apartment rents, they declined from 2019, and they are just now reaching 2019 levels.
Wow.
So you can imagine, people think, well, what's the difference? A landlord gets a couple $100 less. But the way things work in San Francisco, with rent control, everything is the way real estate works, everything is leveraged. So, costs have increased tremendously, and rents, and of course, if you need to refinance, those rates are practically double. And rents are now lower. So that's why there's been a lot of movement for the bigger landlords, the over leveraged landlords in San Francisco, the Veritases, the Ballasts, the Lendys, Mosser. Those companies could access Wall Street money, which was Wall Street gave them 85% loan to value of the loan.
Oh, wow.
But they were short term. They were 1 to 2 to 3 year loans.
Right.
They thought, well, rents are going up. We'll take those loans and we'll turn them. We'll refinance. We'll do all the work, and all those companies greatly improved the buildings, and they got caught. Now, bank lending is different. Banks don't lend like that. My typical loan, the area has been was in the low 60% range in terms of.
Right.
Banks are much more conservative since the financial crisis of the 80s. I don't know if you remember 88, 89. I don't personally remember it, but at that time they changed the rules. So each property has to support the income from the property itself has to support the loan. So you could be Bill Gates and come to me for an apartment loan, and you would get about the same loan as Bruce Bean.
Right. They didn't care.
Yeah, because really it's based on it's based on the income of the property, and only secondarily we have to have a guarantor who can fix the roof if it blows off, that type of thing.
Right. But it was all based on the economic.
It's on the property primarily.
Property. Yeah. Right.
And so really you haven't seen the mom and pop distress and there aren't a lot of buildings in foreclosures because they didn't over leverage. And bank loans are typically 30-year loans, but fixed for 3, 5, 7, or 10 years. So typically, say you got a 3-year loan, and then after 3 years, it reset to a high rate. Well, as long as you can pay that high rate, you will keep the building.
Right.
It's a little bit different. It's not like you have to go in and refinance, because a refinance is much tougher. You have to re-qualify rather than cobble together some money every month.
Right. So are you seeing, well, I suspect you're not seeing a lot of office building loans right now.
I'm actually working on one right now. Actually.
Oh, wow.
Yeah, and it's a nice little building in Saratoga. But you're right. I'm not. A lot of lenders, if you say the word office, they say, you know what, this is just not our thing right now. So
yeah. But okay, going to other property types, industrial, retail. What are you seeing out there? Are loans starting to move?
Things are starting to open up, and so as I mentioned, that there's 3 things that are driving San Francisco real estate. We've got AI, turn to office, which is improving, and AI is bringing people into the city as well as renting some commercial space. We've got return to office, which is bringing people back downtown, and is helping retail a little bit, and is helping apartments too. I mean, because you want to be closer to your work. And then we also have interest rates. That's the third thing. They have declined, but one of the things that people don't realize about the way banks work, is that we saw a lot of distress in the banking sector. We saw First Republic go under. We saw Silicon Valley Bank go under. We saw Bank go under, as well as many of the smaller banks merged. We had Luther Burbank that just merged. We had, I was with Umpqua for 6 years. They just merged. We have, I was with Home Street. That was my most recent bank. They just got, bought by Mechanics Bank. I was with, Pacific Western Bank, before Home Street, and they're gone too. They're part of California Bank and Trust now. So, but it wasn't because they made any bad loan. The problem was banks can only lend based on how much capital they have. Banks can only hold certain things as capital. You can't hold, it's not stocks. It's really basically government bonds. And when government bonds, when the rates went from 3 to 6, just mathematically, that has the value of the bonds. So if their reserves are reduced, then they're not allowed to lend. You're only allowed to lend a proportion of their a percentage of their reserves. So the banks had to stop. And what's happened is now that we're 3 years out from this, they've been able to recapitalize. Either they merged or they just retained their earnings. So now the banks have some more liquidity and they're able to lend. And so that's another thing that's helping real estate right now. So banks are able to lend and rates are a little bit lower. And people have gotten used to it. That's another.
Yeah. Did you deal with Silicon Valley Bank at all?
I did not. No.
Okay.
I actually was with Pacific Western Bank that had a competitive division. The Silicon Valley Bank had a very odd business model. They basically banked startups.
Right.
Startup would do a funding round and acquire 15, 20 million in capital. And then they'd need to grow up and get a bank, manage it for them. So one of these venture banks, Pacific Western Bank had a division. Silicon Valley Bank was the big boy. They would say, okay, give us your 20 million. We'll invest it. And they'd invest it in short-term treasury ladders, bills, because these things are always burning off your funds.
Right.
And we'll invest it for you, and we'll give you a line of credit, which they charge for. So they could take your money as a deposit and charge you for banking services and for a line of credit, etc. It seemed like a bulletproof business model, but it wasn't. Silicon Valley Bank isn't here anymore because their depositors were also their borrowers, and that's not a good idea.
Well, that was First Federal also, right? They did that.
I'm not aware of that company. I don't know.
Yeah. So anyway, yeah, a very dangerous thing. So anyway, so what's your crystal ball? If you can see it at all, what do you think the future's bringing here?
Oh, San Francisco is coming back. I mean, there's never a doubt. It's just too great a city, to go into some, to go into a doom loop. I mean, there's a lot of players who, when San Francisco, does have a periodic crash, and we had a crash in the early 2000s, the dot-com buyout.
Right. Yeah. The dot-com bust. Yeah.
That's right. I remember one of my clients who was desperately trying to buy in San Francisco. And he was furious because the prices didn't get as low as he thought they should be. right? Because he was waiting. He said, they're not showing me those buildings. I know their prices are lower than they're showing me, and he never bought because there's always people who say, oh, I missed it the last time.
Right.
If that ever comes around again, I'm there. And it came around again.
Yeah, right.
Although I don't think there were any screaming bargains, but when one of those big players like Veritas or Ballas, when they walk away from a portfolio, that means that their equity is gone, and it's just and even the loan might take a haircut too. So someone is buying it for they're buying it for less than it was purchased whenever it was purchased.
Yeah. All right. Well, this has been very revealing. I'm looking forward to San Francisco coming back. Obviously, the new mayor seems to be doing some wonderful things. So what's your thoughts there?
I'm cautious. I mean, he's a town school boy.
Oh, yeah. Okay. All right.
That's
Good. Yeah.
good he is. And I have some other connections to him too. So I really feel like San Francisco. I mean, I also think the mood of the city is positive. You go downtown, and there aren't a lot of stores. Union Square is pretty forlorn in terms of retail, but there's a couple new guys coming in, and the streets are clean, and it feels safe, and I really don't have a doubt. I think the idea of making downtown a 24-hour city, which is what Willie Brown wanted to do 20 years ago.
Right.
That's going to work. It's going to play, and it just takes a little time. I mean, you want to build a building tomorrow, it's going to take you. If you start tomorrow, it's going to take you 5 years to get that thing up. So.
Yeah. Right. It's not going to happen overnight for sure.
Right.
But they're trying to streamline the process, but it still takes a long time.
That's true.
So, well, I think San Francisco is definitely coming back. I think we should talk again in 3 to 6 months and see what our predictions look like.
Well, you know where to find me. And can I tell your listeners where to find me?
Yeah.
So you can find me at WalkerRealtyCapital.com or 510-332-6964, my cell phone, or my email, mlipsett@WalkerRealtyCapital.com.
All right. All those folks out there in the audience that are looking for a loan, you got to go see Marc, right?
I appreciate it. Thank you, Bruce.
Thank you so much. We'll talk soon.
That's a wrap on today's journey through the SF commercial real estate scene. Ready to share your story? Visit sfcommercialconversations.com/guest. Your insights could lead the next conversation.